In this lesson, we will continue our discussion on different various types of income. So, continuing our objectives from a previous lesson, after this lesson, you'll be able to recognize various types of income documents and summarize the taxability of each type of income to the taxpayer. So in this lesson, we're going to be talking about tips, scholarships, household employee income, interest, dividends, alimony, gambling winnings, and jury duty pay. So taxpayers who receive tips will typically be in jobs such as waiters, waitresses, bellhops, things of that nature. And they may have tip income that needs to be reported. So tips totaling more than $20 a month will already be reported to the employer and totaled in box 1 of their Form W-2. However, tips totaling less than $20 a month are not required to be reported to the employer. However, they must be reported to the federal government on the federal income tax return using Form 4137. Tips are going to be classified as earned income. Now, if you'll remember from our discussion on wages and the Form W-2, allocated tips are going to be reported in box 8 of the Form W-2. Now, most tips, like I said, are already totaled up in box 1 with wages. However, allocated tips are listed separately. Just as a reminder, allocated tips are the difference between the tips the employee reported to the employer and what the employer designated the employee's tips should have been. And the reason that these amounts are separated out from box 1 wages is because FICA taxes have not been withheld from allocated tips. FICA taxes must be paid on this additional amount when filing a federal income tax return, again using that same Form 4137. So if taxpayers have jobs in which tips are normally received, make sure you ask them about any tips that they may have received that were unreported. So any that are greater than $20 a month, like I said, and reported to the employer, those will already be in box 1 of the W-2, so there's nothing additional you need to do. Allocated tips will be reported in box 8 of the W-2. They must be reported on Form 4137, and they will be subject to FICA taxes. Now, if they are less than $20 a month at one job and not reported to the employer, they still have to be reported as income using the Form 4137. However, these amounts will not be subject to FICA taxes on this form. Next, we have scholarships. So scholarship money used by a student pursuing a degree to pay for tuition, fees, books, supplies, and equipment that is required of all students is going to be considered non-taxable. However, scholarship money used for room and board is taxable, even if it's required for enrollment. The taxpayer may receive a Form W-2 for the taxable scholarship. However, they might not receive one. If they don't receive a Form W-2, it still does have to be reported as taxable income. Often taxpayers who receive scholarship money will have that amount reported on a tuition statement, and that tuition statement is called a Form 1098-T. This is a form we'll talk about in much greater detail in Unit 2. But remember that if money was applied to tuition and required books and fees, then the money is not going to be taxable. But if the scholarship money on this form was used for room and board, that will be taxable. Scholarship income can be classified as either earned or unearned income depending on various factors. However, taxable scholarships not reported on a W-2 are always going to be considered unearned income. Next, let's talk about household employee income. If a household employee earns less than a certain amount each year, the employer is not required to issue a W-2. So when we talk about household employees, we're talking about maids, gardeners, any kind of lawn worker that a taxpayer may hire, any kind of worker that would work in the household. So if a household employee earns less than a certain amount, they're not required to issue W-2. For 2015, for the tax year 2015, this amount was $1,900. However, this amount is subject to change from year to year. You can always go look at the publication 926 that will offer the most up-to-date number for the current tax year. Federal income tax and FICA taxes aren't required to be withheld on this income by the employer. However, household employee income must still be reported on the taxpayer's income tax return. So just because they don't get it on a Form W-2 does not mean that it doesn't have to be reported. It does. This is going to be classified as earned income. Interest income will most often be reported to a taxpayer on the next form, which is a Form 1099 INT. So let's briefly take a look at each of the boxes that we will be looking at in more detail on this form. First, we have boxes 1 and 3. Boxes 1 and 3 report taxable interest paid to the taxpayer during the year. That's box 1. And box 3 shows interest on U.S. savings bonds, treasury bills, bonds, and notes. Box 2 is going to report the amount of interest or principal that was forfeited as the result of an early withdrawal. Okay, so that is a penalty that is assessed on the taxpayer. Box 4 will show any federal income tax withheld on taxable interest. Box 6 is going to report any foreign tax that was paid by the taxpayer. And box 8 is going to show tax-exempt interest paid to the taxpayer. So let's look at these boxes more closely. So boxes 1 and 3 are going to show interest and interest on U.S. savings bonds and treasury obligations. So money is going to earn interest when it is deposited into a bank account. So for example, savings accounts, checkings accounts, things of that nature. Or when it is used to buy certificates of deposits or CDs or bonds. So interest is taxed in the year and is credited to a taxpayer's account. So this interest income is going to be classified as unearned income, which makes sense if you think about it, because the taxpayer is not actually doing anything to earn that income. It is just accumulating on money that they already have sitting in an account. Let's take a look at box 2, the early withdrawal penalty. If an early withdrawal penalty is incurred, it's going to be indicated on the taxpayer's tax statement. This is just going to show interest and principal that was forfeited because of an early withdrawal of time savings. So example of this might be if money was withdrawn from a certificate of deposit that has a time limit before withdrawal is allowed. Okay? In that case, a taxpayer might have been assessed an early withdrawal penalty. Now there is an adjustment for this amount. We're going to cover that in a later training. It allows them to offset the amount of early withdrawal penalty. But we will again discuss that in Unit 2 when we discuss adjustments. Box 4 will report any federal income tax withheld. Taxpayers may have had federal income tax withheld on their taxable interest in some circumstances, which will need to be included when reporting this income on the federal income tax return. Box 6 is going to show any foreign tax paid. Foreign tax paid will be reported on the Form 1099 INT, and this amount can actually be taken as a non-refundable tax credit, which we will discuss in a later training. Box 8 is going to report any tax-exempt interest that was paid to the taxpayer. Now, tax-exempt interest is non-taxable, but it still must be reported on the taxpayer's income tax return. Let's take a look now at the Form 1099 DIV, which reports dividend and distributions. Okay, so dividend income is most often going to be reported on this 1099 INT. So let's take a little bit closer look at each of the boxes that we will be looking at more in depth on this form. So first we have 1A and 1B. 1A and 1B are going to report taxable dividends paid to the taxpayer during the tax year. Box 2A is going to report taxable capital gains distributions that the taxpayer received during the tax year. Box 4 will show any federal income tax withheld on taxable interest, and Box 6, much like the 1099 INT, is going to report any foreign tax that was paid. Ordinary and qualified dividends are going to be reported in boxes 1A and 1B. So what's a dividend? Dividends are payments made by corporations to shareholders. Okay, it's the distribution of a portion of a company's earnings to the shareholders. So for example, if a taxpayer has investments in a stock, then the dividends paid by the corporation are taxable. They are reported to the federal government annually, and they will be classified as unearned income. Capital gains distributions are going to be reported in box 2A. Capital gains distributions are the income a taxpayer receives when selling stocks and securities in a mutual fund. So this is essentially what a taxpayer will receive when selling stocks, the gain that they receive on those stocks. These amounts are taxable, but we will discuss stocks, securities, and capital gains in a later training. Box 4 will once again have federal income tax withheld on these dividend distributions in certain circumstances, which will need to be included when reporting this income on the federal income tax return. And then once again, box 6, foreign tax paid. This amount can be taken as a non-refundable credit, but again, we'll discuss this in a later training. Let's move now to alimony. Most everyone has probably heard of alimony, but just in case you haven't, alimony is a payment to or for a spouse or former spouse under a separation or divorce instrument. The person receiving the alimony has to report it as income on their tax return. Just a quick side note here though, the person paying the alimony can actually take the amount as an adjustment, but we will discuss how to do this in a later training. Alimony is going to be classified as unearned income. Alimony may include a number of expenses, including medical bills, housing costs, and other various expenses. However, it does not include child support. All right? That's a common misconception that taxpayers have. It does not include child support, and it also does not include any voluntary payments made outside of the divorce instrument. So a spouse may decide out of the goodness of their heart to pay a little bit extra each month to their former spouse outside of what the divorce decree states that they must pay. That additional payment is not considered alimony. So how do we determine what is considered child support and what is considered alimony? Well, child support payments from a separation or divorce instrument are going to stop once the child is an adult. Alimony does not necessarily end when a child is grown. Typically, alimony will continue on past that, all right? But child support will stop once the child reaches 18. You're going to need the exact amount of alimony from a divorce or separation instrument executed after 1984, okay? And the amount of alimony reported on one tax return as income must match the alimony adjustment reported on the spouse's tax return. Again, we'll talk about that adjustment later on in a different training. Let's move now to gambling winnings. Gambling winnings are taxable and they are typically reported on a form just like this, a W-2G, although they are not always reported on a W-2G. Sometimes the taxpayer will just tell you that they have won a lottery or some other type of gambling winnings. However, all gambling winnings are taxable. So just a closer look at these forms, you'll see here there's gross winnings. It'll show the date won. It'll show what type of wager it was. So that would be slots, lottery, some other type of gambling mechanism. It'll show any federal income tax that was withheld. Then there might also be some other various type of information reported about where the gambling income was won. The bottom will show any state information. Again, it may not be taxable in every state, but if it is, it will show state winnings and show state income tax withheld, as well as local winnings and local income tax withheld. All right, so a taxpayer may receive one or more Form W-2s in reporting gambling winnings. Okay, those will all need to be entered in on the return as income. However, just a note that gambling losses can be taken as an itemized deduction, okay, but only up to the amount of winnings. So a taxpayer may have $20,000 worth of gambling income, but they may have $40,000 worth of losses. On the tax return, up to $20,000 of that can be taken as an itemized deduction. But we will discuss this more when we get to the itemized deductions training. Gambling winnings are going to be classified as unearned income. And finally, as concluding our income section, we have jury duty pay. Jury duty pay must be reported as taxable income. This would be pay that is received for serving on a jury. Often taxpayers will receive a certain amount per day for serving as a juror. Some employees will continue to receive wages while serving on jury duty, And in that case, compensation will often be turned over to the employer. So any compensation that they receive from the courts will be turned over to the employers. In this case, jury duty pay must still be reported as taxable income. However, there is an adjustment to income to offset this amount. We're going to cover this in a later training when we discuss adjustments. And jury duty is going to be classified as unearned income. This is going to complete our lessons on income for Unit 1. After completing this lesson now, you should be able to recognize various types of income documents, as well as summarize the taxability of each type of income to the taxpayer.